Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Welcome, ladies and gentlemen, to the Algorithmic Advantage. We are very happy to be speaking with Alan Clement today. Before we introduce him, I'll say hi to my co-host. How are you, Rich?
Very good, Simon. How are you? Good to see you.
Very good.
And hi,
Indeed.
Alan. How are you?
G'day, Alan.
I'm very well. Thanks for the invite to be on the show. I'm looking forward to it.
What's the weather like in Melbourne?
Well, you know what they say about the Melbourne weather. If you don't like it, just wait 5 minutes.
Indeed. Well, it was good to catch up, Alan, in Brizzy. People don't know that Brisbane is now the new quant headquarters, global quant headquarters. So, yeah, we had a good catch up. Shout out to Dave. Thanks to Dave for organising that. It was good to have a few of us all get together and talk shop in Brizzy a little while ago. That was fun. So we thought we'd continue along those lines and get you on the show and talk about equities trading. We've talked to a lot of people about futures. We've also talked about trend following, classic trend following. And you and I both trade equities, and we both trade a diversified set of strategies. So I wanted to get someone on the show who I could have on my team, so to speak, for a bit. And we can talk about equities, the whole gambit of the options that are available to us, the kinds of strategies we can deploy, the advantages of equities, and so on and so forth. So why don't you start by giving us a background and how you got into trading, and we'll launch into it from there.
Sure thing, yeah. So my background in a professional sense was in the finance world. I've worked in asset management firms and in large investment banks in the UK mainly. And my profession was software development. So whilst I was doing software development, I was basically getting steeped in the financial world. And then when I left the corporate world in the early 2000s, I decided to have a go at becoming an independent trader. So I learned a little bit about technical analysis, tried, trading ones and twos for a couple of years, got sort of fairly decent at it. But then it wasn't really till I discovered the world of quant trading, and somebody gave me a book on systematic trading, and kind of lots of light bulbs started flashing in my head. Having come from a software development background, I realized that I could use those skills and apply them with some of the sort of technical analysis knowledge and actually start developing my own strategies. And that's really when I started developing some more consistency in my results. And I've really just gone from there, sort of, as you say, I've diversified into trading uncorrelated strategies, mostly in the equities world. Probably unlike most of the guests you've had on so far, I'm very much steeped in the retail world rather than the institutional world. So that's the sort of the side I come at it from, and I've just gone from that sort of background to developing quant strategies and becoming more and more proficient as the time goes on.
Which many of our listeners will be interested in, because many of us start from the simple, and we're trying to gather information. I think no matter which background we come from, we're all very quickly gravitating toward the same sources and the same kind of education and information and mentors if we're serious about it. So it's good to know how to build up and what the options are along the path. Okay, so tell us about equities in general, like why equities, and what are some of the advantages of trading equities?
Well, I think in the retail world versus the institutional world, there's a few advantages. One is the simplicity of equities. You you can buy them without requiring margin. They never expire. You don't have to worry about things like rollovers, managing a futures margin account, and so on. So I very much like the simplicity of holding an equity, and you can hold it for 5 minutes or 5 years, and it doesn't degrade or expire. So it's like a futures contract or an options contract. So that's certainly one advantage. I think another advantage that retail traders have is capacity. A lot of institutional traders are limited by capacity constraints, whereas in the retail world we can be a little bit more nimble and trade stocks that that have liquidity levels that institutional players just wouldn't be able to play in. So again, that gives us more options, and there is such a wide array of equities out there that you can pick and choose the markets or the indexes that you play in. So all of that together, I think, gives us the retail world a lot of advantage. The other one I would add is the correlated nature of equities as well. So whilst they are lots of discrete instruments, they do exhibit a high degree of correlation in some aspects, and that gives us the ability to construct strategies and portfolios that can take advantage of those correlation aspects. Yeah.
Sorry, Alan, just quickly, how do you deal with corporate actions and dividends? Like, obviously it's from your data supplier or whatever, but I suppose that's sort of a difference between stocks and, say, futures, where we've got the rollovers and things. But so how do you deal with the corporate actions and dividends?
Yeah, that's a good question, Rich. I mean, especially as strategy developers, the data that we get is very important. So there is a degree of discretion about how you deal with these various forms of corporate action, and you have to. In my mind, anyway, you basically have to have a policy about, where do you include this action? Do you exclude this action? How do you deal with splits and so on? I think that sort of the main way that I attack it is to use a very reputable data supplier who handles a lot of that stuff already. So shout out to Norgate Data, who's the company I use. And they take care of a lot of that stuff and provide basically back adjusted time series which you can then decide which corporate actions you include or exclude, and whether you adjust for dividends and so on. So that gives us basically a clean, reliable data source which we can then develop our strategies on top of and get results which you can reasonably rely on as being. It's never going to be a perfect match for what happened in the past, but you can draw some reliable conclusions which will help you decide whether the strategy you're developing has any efficacy going forward.
Yeah, it's handy with Norgate. They actually even give you options as to how you will choose to back adjust, and really they do take care of all the heavy lifting for you.
Indeed, yeah.
The other thing I like about equities is just there being so many of them that you can really develop those portfolio style strategies that are trading any instrument that becomes available on the day, and there are so many more instruments. So it's a different way of building strategies, if you like, than for building strategies for a single name or a single contract.
Indeed, yeah. Yeah, and that gives us a lot more flexibility, I think, than if you're just trying to develop a strategy for the oil market or the gold market or a particular FX pair. The fact that we can pick and choose and select equities based on many different criteria, really, to get to build a portfolio of equities that suits a particular style of strategy, or find equities that exhibit particular properties or movements in their prices, particular volatility levels, for example. And that, if we can then use that wide, you start with a sort of a wide net, if you like, and then slowly narrow down so that you end up with a portfolio that gives you exactly what you want.
So how do you look at finding market inefficiencies in the equities world? How do you look to extract alpha?
Yeah, so I think that that my philosophy in the trading world, if you like, is that we the only way that we can profit from the markets is by targeting particular inefficiencies that the markets exhibit. The markets are highly efficient pricing mechanisms. And it's very difficult to extract edge unless you know exactly what the inefficiency is that you're aiming at. And the the markets exhibit lots of different types of inefficiencies, and it requires a specialist type of strategy to be able to mine, if you like, that particular inefficiency. So in the retail world, a couple of the big ones are going to be things like momentum and mean reversion. So momentum is, the tendency of trends to persist in the market. Once the trend is underway, it will, especially the stronger the trend is, the more likely that is to persist.
Pick me.
Yeah, yeah, that way or that way. And with something like the mean reversion tendency, that or inefficiency, that's if the market deviates too far from the mean of its direction, whether that's the trend or moving average, however you define it, then it will, the further away it gets from that mean, it will tend to bounce back. So that's the kind of the sort of sawtooth action that you see within the trend. So obviously you need for those two big ones, there's obviously two different types of approaches required. So that's where I would start from is, okay, well, what is the inefficiency I'm aiming at? And then drill down from there and say, okay, well, what's the best type of strategy that I'm going to be able to apply? So for momentum, that's going to be something trend following. For mean reversion, that's going to be more of a sort of short-term swing strategy.
So, Alan, I assume you're doing a lot of research to identify these edges first. And once you've found the particular edge, you look at a targeted way to exploit that opportunity with that edge, as opposed to, say, the typical data mining method where you just throw in all the data and you let the machine work out what it wants to do. You're saying, do the research, identify the edge you want to exploit, then target your development towards that, exploiting that edge. Is that how you're looking at it?
That's correct. Yes. So first of all, what is the market property? What is the market exhibiting that you're trying to capture? So if it's a trend, then you need some way to define what that trend is. You need some way to quantify the strength of that trend so that you can then build a strategy to select the instruments that are going to give you the best bang for your buck in terms of identifying that trend. If it's something like mean reversion, then you need to look for periods where the market is quote unquote overbought or oversold or exhibits high volatility, and then you look for the volatility to collapse. So again, it's finding those particular properties of the price movement, and then, as you say, building a particular strategy that's going to be able to quantify those. So for mean reversion, you're looking for periods where either the market's overbought or oversold, or the volatility in the market's exploded and you're looking for it to collapse. I mean, essentially, in all cases of strategy development, what we're looking for is price patterns which precede profitable outcomes. So we want to find the pattern that comes just before the market moves in a particular direction, so that we can then profit from that. So it's what set of circumstances or properties of the price movement are going to give you that nod that something profitable is about to happen. Yeah.
Alan, when we've spoken in the past, you've said they're not necessarily the only two things that you're looking at, momentum, mean reversion. There are other ways of looking at market inefficiencies. Can you talk to that a little bit?
Yeah, sure. So maybe I'll share a little slide on that at this point.
That'd be good. Yeah.
So as I said, there's a number of different market inefficiencies, and some of them are going to be easier to capture for retail traders than others. Momentum and mean reversion, we've talked about. Those are kind of the two big ones, and in a sense, the easiest to capture by developing strategies. Then we've got something like seasonality, which is, the market moving in cycles. And we have, the famous axioms like sell in May and go away, the Santa Claus rally, the January effect, the end of the month effect. These are all well-known cyclical things that happen in the market that can be captured profitably as well. So you would use, something like a cycles approach or some of the GAN techniques. Those are a little bit harder to nail down. One, because they don't happen with any sort of frequency that gives you the ability to test them reliably, but also capture them moving forward. Sell in May and go away, and the Santa Claus rally only happened once every 12 months. So it's very difficult to build a
Alan,
strategy.
how did you find GAN? I know he gets into some esoteric things, but I suppose there's a lot of stuff that's applicable. What do you like out of GAN?
Well, some of his sort of swing strategies can be easily tested, but a lot of this stuff is, as you say, is so esoteric that it's just impossible to build a model that can actually test it in any efficient way or it's a lot of it is just too woolly in my view for it to be able to capture, especially when you get into some of the planetary
astrology
stuff.
Yes.
That's woo land. Yeah.
I have
GAN is a difficult one, but he does have a couple of systematic things that his swing stuff can be generated. Yeah. And then we've got things like volatility. So we know the volatility in the market, in all markets, really expands, contracts. And so if we can try and detect that expansion or that contraction and basically bet that it's, when it gets to an extreme, it's going to move in the other direction. You can use things like options and so on to capture that, option strategies. I look at something that looks at the VIX futures term structure to try and work out what the future expectation of volatility is going to be and try and take a position, a trend following position basically in the market, either long or short, especially in the equities world. Short volatility, and when the volatility has been high and we expect it's going to shrink, tends to mean the markets are going to move up. And in the equities world, we always have that upside bias, which is produced by the survivorship bias nature of the index constructions. So that's something we can profit from.
That's
and then further down the list,
another distinct attribute of equities we missed, isn't it? That upside bias.
Yeah, that's right. Yeah, which can work in your favor. Certainly can work against you if you're trying to short equities as well. But yeah, you have to always take that into account.
And Alan, that's only found in the index world of equities, isn't it? That long bias. You don't find it in the individual stocks themselves.
Yeah, absolutely. Yeah, which is again why when you're back testing some of these ideas, you really need to use techniques which include survivorship bias. So you want to make sure if you're trading a particular index of stocks that you're actually testing that index as it was historically. And again, Norgate do a very good job of providing the tools and functions that you can use to actually construct the index historically. Because as you say, you will, if you just test the index using the current constituents, they're only there because they're survivors, and your results will look very good historically, especially in things like trend following approaches. And you will be missing all the ones that you would have held, but are no longer in the index. So, yeah,
Alan, how are Norgate in relation to global equities? Are they focused on any particular countries like US, Australia, or do they also deal with more global equities?
The three big markets they have data for currently is the US, Australia, and Canada.
Okay.
I believe they've tried to to get reliable data from other markets, but their data quality standards are so high that they haven't been able to capture any other markets reliably yet.
Gotcha.
Yeah.
On GAN, actually, I have a bit of I remember GAN books in my library. Well, they're still there, and it goes back to when I used to work at the Sydney Futures Exchange, actually. And when I started there, they weren't a publicly traded company; it was a mutual. And as we were becoming a publicly traded company, a new CEO came in and shut down the library, because we used to really think of ourselves as providing a public service, and we had a library, and anyone could come in, and futures traders could come in and pick up books and learn about futures trading and all of that. And it was a great little library. And when they shut it down, these books were all just going to go really get offered off to donated to various channels. So we got permission to keep a couple, and I grabbed all these GAN books. And I just remember they were like big hardcover things with all these plastic, what do you call those, plastic sheaths in there with all the charts on, like those overhead projector slides, so to speak. And I never really I could never really get past about page 3, so I ended up not getting into any of it. But anyway, that's a bit of a side story on GAN.
Alan, can you go into this co-integration component? So you've gone through to volatility. Can you explain the co-integration?
Yeah, so co-integration is probably better known as pairs trading. So you think of stocks, particularly that are in the same industry, that tend to move together. So in the Australian context, you might think of BHP and Rio, for example, or in the US, you might think of Ford and General Motors. So because these companies will have the same economic pressures on them, both positive and negative, their stock price will tend to move together. But on occasion, they can diverge for one reason or another, either something based on the individual stock or company is different to the other, or they just diverge for supply and demand reasons. And the theory of co-integration is that if these stocks diverge far enough apart from each other, they will tend to bounce back to become more in line. So you can use what's called the statistical arbitrage approach to that, which is just to look at the ratio between them and just wait for it to get to an extreme and then bet. You basically go long one and short the other one and bet that they're going to move back together.
And Alan, can you also trade the divergence as opposed to the convergence of those spread trades? Like if, for instance, your outlook is that BHP is going to be eminently more successful than Rio over the long term, with the expectation you're going to get this divergence, is that how you can effectively trend follow the spread?
I guess you could, yeah. It's not an idea I've tested myself, Rich, but I guess that would be something. The thing I've found, certainly from a retail investor's point of view, with attacking something like co-integration, is because you're always long one and short the other, you're always going to end up with one loss and one win, and you're just basically picking up the spread between the two. So you usually, to make these things work, you're better if you can apply a whole heap of leverage to it to actually, make it worthwhile. So it's a little bit out of the reach of most retail traders, and it tends to be something, in my experience anyway, it tends to be something that's the institutional world play in or can play more successfully in than the retail world.
What I love about those spread trades, Alan, is that it removes the sector risk out of their spread trade. And, you'll be hearing all of these people crying out loud about the market downturn, and you'll be saying, "Hey, I'm spread trading. I can't feel this effect." It's a great it's a great effect. Yeah,
it is. Yeah, and it's the classic that approach, is the classic hedge fund approach, if you like, because you're basically hedged in the market, and you're removing, as you say, the sector risk, but you're also in a way moving the market risk as well. And that's probably one reason why they don't generate a lot of return on an individual trade basis, because, as where there's return, there's always risk, but not necessarily the reverse is true. And so if you squash that risk, the return you're able to generate is also going to be squashed.
Yeah.
So
exchange latency, please explain.
Right. Well, again, this is the further down this list, the more and more institutional it becomes, or the more and more large amounts of capital and infrastructure you have to throw at the idea in order to extract the alpha. Exchange latency is the idea that a particular instrument is traded on two different exchanges, and whilst its arbitrage should keep its price in sync, there are periods of time because of the latency that exists between those exchanges where the price can diverge a little bit. And if you're quick enough, you can get in and buy or sell one side of it and capture the spread in between. But you need to be extremely quick because the latency is measured in microseconds normally. And so that tends to be something like a high frequency a trading approach, or what can otherwise be called latency arbitrage. Really, is what you're trying to extract there. So.
Do you play in that arena of high frequency?
No, certainly not. No. I tend to be mostly end of day trades, just because it's easy and that's where I found the sweet spot to be in terms of extracting alpha. If the deeper you go into the intraday price action and market microstructure and so on, the harder and harder it becomes to extract the small amounts of alpha in there. Number one, because your competition are the institutional players at that level, and so you really are fighting an uphill battle to beat those guys with all their big levels of infrastructure and big guns at the other side of it.
Okay, Alan. So, on your general philosophy of trading, then what's your high level, and then from there we'll go down into the specific strategies that you trade.
Yeah. So I think before developing any sort of strategy or deciding how you're going to trade, you first need to have a goal in mind. There's no point just jumping in, because as you know, there are limitless numbers of trading strategies out there, or ways that you can trade the market. Most people, when they're beginning, they just jump in and they'll read something on a website, or they'll watch a YouTube video, or they'll read a trading book, and they'll think, oh yeah, that's the answer, or that's the answer. But most of the time they won't know whether, number one, it will suit their style, or number two, whether they'll actually be able to execute it with any efficiency and extract the same results that the author is getting. So I think it's always better to start off, well, what is it that's going to suit me, and then sort of drill down from there to try and find a strategy that matches those outcomes. So you can start with a high level goal is, I want to, let's say something like, I want to generate return in a bull market and avoid bear markets. That could be a sort of overarching high level goal. But I think when you get down to the strategy level, the good thing about the way that strategies can be tested and quantified is that they have quite specific outcomes, and these outcomes, in my mind, kind of fall into 6 or 7 buckets, which is what with the slide we've got on the screen at the moment. Mm-hmm. So we've got things like return, drawdown, turnover, holding period, win rate, expectancy, and the thing about these is they are true for all strategies, but they also interplay differently in different kinds of strategies. So you can have, so for example, the return and drawdown are tend to be inversely correlated. The higher positively correlated, I should say. The higher the drawdown, the higher the return, generally the higher the drawdown. If you're shooting for a 10% return, you can probably try and get away with 10 or 15% drawdown. If you're shooting for a 50% return per annum, boy, you're probably going to end up
hasta la vista.
You're having to carry blow up risk every year. So I think the first thing is to consider is, well, what's my risk appetite? How much drawdown can I withstand in my portfolio? And certainly from a retail trader's point of view, I'm going to be able to withstand more drawdown in my own personal capital than an institutional fund manager would. If he got any more than 10 or 12% drawdown, he'd be looking at heaps of redemption. So that will then allow me to shoot for a much higher return than somebody who would have to cap their drawdown at a much lower level. And then you've got things like turnover and holding period. So they will be different for different types of strategies. So for a short-term mean reversion strategy, you might be turning over lots of trades, turnover being your trade frequency, and your holding period might be very small. Whereas for a trend following strategy, your holding period is going to be much longer and your turnover will tend to be far less because of that long holding period. Win rate. People, like strategies that win 75% of the time, but in order to achieve that, you have to accept that you can only take a small bite out of the market each time. So your expectancy per trade is going to be quite small. Whereas if you're happy to accept a 50% win rate, you can shoot for a much larger expectancy because you can then withstand the market risk that's going to produce many more losses within that.
Do you want to just quickly explain expectancy in case some of the listeners want to understand that deeper?
Yeah, absolutely. Yeah. So your expectancy, the simplest way to explain it is it's your average profit per trade or loss per trade. But if you take all your trade outcomes in a back test or in a real world test, and you average out all the P&L per trade, usually as a percentage, your expectancy will be the average of all those trades, given the win rate and the loss rate of that particular strategy.
And profit factor is a very similar thing, isn't it, Alan? Profit factor is a very similar.
Profit factor is slightly different because profit factor looks at your total wins. In my understanding, anyway, it's your total dollar wins divided by your total dollar losses. So it doesn't necessarily look at the individual trade outcomes. It just looks at the totals in an aggregate. Profit factor differs slightly from another one, which is called payoff ratio, which is the average of your average win versus your average loss. But they're all interesting to look at, those different ratios, and they will all give you a different idea about how the strategy operates.
Have you got a favorite?
I've got lots of favorites. So what are the ones I zero in? Well, to get down to the bottom of that chart there, the risk-adjusted returns, I think, is the key one that you would want to look at first for any strategy. One, because that gives you a measure of what your bang for your buck is, how much return am I able to generate for a given unit of risk. And it also allows you to compare different strategies that have different risk levels. So I might have one strategy that has a 20% return and returns, let's say 20%. That would give us a ratio of more or less 1, whereas I may have another one that has a 50% drawdown, but only generates a 25% return. So that's a much poorer risk-adjusted return. So things like MAR ratio are good to look at. And then we've got things like Sharpe and Sortino ratio and different forms of measuring that risk-adjusted return. So that tends to be the one I go to most. And the other one I would probably give a notable mention to is what's called the Ulcer Index, which looks at how long and how deep are the strategy drawdowns. How big is the ulcer going to be in your stomach by trading this particular type of approach?
Actually, Alan, check out the Serenity ratio, which is an extension of the Ulcer Index. So it's going that one step further. But I tried calculating it, and it takes about a day to calculate it. But yeah.
I haven't come across that one.
Yeah, Rich, you can tell us more about that. I know you've done plenty of work on it. But what I love about this, Alan, is this is actually really important, it's like this is the art side of trading to me too, because you can start off and say, well, these are my goals and objectives. But as you start to build things out and you're testing things, you might realize you need to utilize different metrics or look at different aspects of the strategy in order to test it properly or enhance it or research it better. And some of the things that are on there are portfolio related or portfolio calculated. Well, whilst sometimes I find it really important too to look at just the pure trade metrics Win rate, for example, is one, and that's where I do like payoff, because I like to see the win rate and the payoff separately, and it's a bit like they're components of the expectancy and of the profit factor. But it's good to see, depending on what it's an argument for specialization too, actually, is as you spend more and more time on a particular strategy type, say, or learning about a particular aspect of the markets, then you're going to learn what works best for that strategy and what things you need to look for and analyze most deeply. So, and the average investor barely spends any time on this. So, that's a really important point too, is even the average investor could do with spending some time thinking about, well, if I've bought and hold the S&P, 500, what is my actual historic drawdown risk? Well, I'm looking at a 50% drawdown. That's quite significant. Is that really what I want to go for? So I think this is a really important building block in becoming more statistically minded about our trading.
The other thing is that different types of strategies deserve different types of metrics. I actually find that, for instance, if you're bundling mean reversion into trend following and all of these different things, I don't find that there's an ideal metric to evaluate all of them. There are specific metrics that do better in some areas than others. So in trend following, I like these path-dependent metrics like MAR, but in mean reversion, I could see why Sharp would rank highly. So there's no one-size-fits-all in this. Do you find that, Alan?
Yes, I do. Yeah, definitely. The risk-adjusted metrics like MAR and Sharp, I think, can be used across different types of approaches. But when you get down to the individual metrics, like win rate and expectancy and turnover and so on, they are going to be very much dependent on the strategy approach. And I think the other thing that's worth saying is, although our goal is to be very systematic in the end, a lot of the decision making that goes into the construction of the strategy can be quite discretionary. If you run a test on your idea initially and you get a set of metrics, some of which you like and some of which you don't like, maybe the win rate's not high enough, or the expectancy is too small, or the turnover is too high, you need to then make a decision about, okay, what is it I need to change or add or remove from the strategy in order to try and get the metrics in such a shape that it's going to suit me to trade this thing live. And a lot of those decisions are very discretionary, even when you run optimization tests, which, are so alluring that you can't not do them. You're always going to select your results from the right tail of the distribution of those results, and so some of these are discretionary decisions that can also be traps.
And just to make it really simple too for those starting out, if someone sells you a trend following strategy with a 60% win rate, I would walk out the door. And likewise, if someone's selling you a mean reversion strategy with a very high payoff or a very high expectancy, I would also walk out the door. So we start to work out what different...
Don't turn around now. You're not welcome anymore.
Indeed. What have you been listening to, Rick? So that's why it's important to to do enough research to get to know what to expect.
Yeah, you definitely get, once you've been in this game for a while and you've gone through that process enough times, you definitely get a feel for what feels right and what looks like it's just too good to be true. And you can really pick these things straight off the back. If something looks far too good to be true, like you say, it's got far too big a return for the amount of drawdown, or the win rate is through the roof. Your first reaction, rather than be, "Oh, I'm going to be a mega millionaire," is where have I made a mistake? Because it's almost certainly going to be a mistake in the code or a future leak or something of that nature that you've done to trip yourself up.
Which lends itself to the next simple step in this whole hypothesis for me, which is that we come away from that retail focus of trying to build the holy grail strategy, and we start to look at other ways to generate returns through diversification, through optimal capital usage, through efficiency of execution, and we realise how important all of these other aspects to trading are, whilst because we are confronted with the reality that, as you said, the markets are very efficient, and as much as we can come in with our goals and ambitions, if those ambitions are not in line with reality, then no matter how many YouTubers have tried to sell us those strategies, it ain't going to happen.
Yeah, that's right. Yeah, so that's why I think the holy grail, if you like, is to be able to trade a suite of non-correlated strategies, which make gains and losses at different points in the timeline, and that will basically give you an overall smoothing out of your own equity curve. If strategies are drawing down and making gains at different times, ultimately you're going to have a smoother ride overall by diversifying your capital into different allocations within those strategies.
Okay, Alan. So let's come back to that. But to start with, let's then talk about your trading approach today, and where have you landed with all of this in the kinds of strategies that you develop? How do you develop them? What do you like to do? And we'll step through that a little bit.
Well, going back to the market inefficiencies, which are going to be the easiest to capture, I would like to pick one or two strategies from each one of those market efficiencies and run them all together. So I have a mean reversion approach, I have trend following approaches, and I have volatility approaches, and then I would bring them all together as a package.
Awesome. All right. Well, can we step through those and talk about them a little bit individually, and then perhaps bring that together with your portfolio approach, your risk management, testing, how you measure the health of these systems along the way, and then we'll sort of wrap up from there. So if we could talk about maybe mean reversion first a little bit. Do you want to talk about, the markets that you trade on, how you construct those strategies? And of course, we're always interested to know with mean reversion how you manage your skew and left tail risk.
Yeah, absolutely. Yeah. So basically what we're looking for in the mean reversion world is two things, really. One is the direction of the market. So for a mean reversion trade to work in our favor, we want the market to move against the overall direction of the trend, and then we basically place a bet that it's going to correct back in the direction of the trend. So we need to know what direction that trend is in to begin with. And in the equities world, you're going to get much better benefit on the long side for that type of approach. So I'm looking for stocks, essentially, which are exhibiting a strong directional trend. And there's a number of ways to measure that, something as simple as it being above a long-term moving average. But there are other methods. You could look at the momentum of the trends, rate of change, those kinds of things. And then the second thing is to look for the market having moved against the direction of that trend in the short term. So we're wanting to filter for things like the market being at an extreme in its recent range of prices. So what tends to be called oversold in the sense of wanting to go long. So we're looking for the market to pull back, essentially. And then we're looking for it to be at an extreme within that pullback. So we could use something like volatility, because the volatility will tend to spike as equities get sold off. And so if we put that all together, we can then select for the market being an extremely oversold position, and then we can place an order either, at that point, or we can either try and capture it a little bit lower. and then we're going to wait for the market to bounce, and then we're going to sell out of that position on a short-term basis.
Alan, are you waiting for confirmation of the retracement back to the equilibrium, or are you mean reverter in that you're actually going in at the maximum excursion?
Yes, the latter. Yeah, we're basically buying as the market's falling, and in some approaches you can actually continue to buy. So you wouldn't go all in on the first position. You might scale in a couple of positions as the market gets oversold, because the further and further the market is to that extreme in its recent range of prices, the higher and the higher the probability is that we will get that bounce back towards the mean of the trend. So I'm always wanting to buy as the market's falling, because if you look, even if you just look on a chart, almost always as the market reverses, it will tend to move quite quickly, and often it will gap overnight. And so if you're not already aboard and you're waiting for confirmation, you're going to miss most of the alpha.
So how do you manage the risk on these strategies, Alan? And do you run multiple of these strategies? And perhaps do you do that scaling in that you've just talked about?
Yeah. So scaling in is one approach, which is going to limit your risk, because you may not be, you're going to limit your size as the market goes against you. Stops tend to be extremely poor in mean reversion strategies, because of the reason that you're buying as the market's falling. So if you have a stop in place, the market's much more likely to plow through your stop before it will revert. So you'll end up with a series of losses which you wouldn't have otherwise had you not had the stop in there.
I remember many years ago, Alan, you said some sage advice many years ago, where you don't like stops because they deliberately introduce drawdowns into your equity curve. I remember that so well. Yeah.
Yeah, you're selling at the worst point and you're locking in drawdown. And if you test these strategies with a stop, the further and further away you put the stop, the better and better the outcomes become, until the stop's so far away it's not even being hit. So how do we manage risk without the stops? So the main approach I use is to basically diversify into lots of different trades. So if you're trading an index of equities, for example, you might take 5 or 10 positions. So you're splitting your capital up, and your individual stock risk is then quite small. If one of the stocks goes to zero, that's only a small percentage of your equity that you've lost.
A small bets.
So yeah, small bets, basically. Yeah.
Okay. So if that's mean reversion, what about on the other end of the spectrum if we're trend following?
Trend following, yeah. So if you look at the literature on trend following, there's lots of different approaches that you can apply, things like breakout strategies, Darvas boxes, and so on. I've tried lots of these different ideas, and one thing that I've found in my research is that if you filter any of these strategies for market momentum, you will tend to get much better and better outcomes the higher you put that floor on market momentum. In other words, the stronger the trend is, the more effective these strategies will be. So if you take that to its logical conclusion, you can take out the whole entry trigger criteria at all and just rely on buying the strongest momentum in a particular given basket of stocks, whether that's an index or a sector or wherever you're playing.
So, Alan, this is a cross-sectional approach you're adopting here?
That's exactly what it is, yeah. So it ends up being a cross-sectional momentum approach, and you apply it using a sort of rotational principle where you rank all of the stocks, you hold a group of the top performing ones in terms of the momentum, and then periodically, whether that's weekly or monthly, you re-rank them and you sell any that have dropped out of that top list and you buy any that have come in.
And are you looking for long and short, or are you just focusing on long for your equities?
Well, again, in the equities world, I find long only works best. That obviously then begs the question, what do you do in bear markets when all the stocks fall and the correlation goes to 1? So you do need some sort of market regime filtering in there to take account of that. So on the rotational side, that gives you two benefits in my view. One is that you're always holding the strongest stocks in the index, so your upside will tend to work quite well. And you are also, because when the rotational nature means you're buying one as you're selling one, so that kind of crossover effect means that your risk side of things is usually a little bit easier to contain as well. And you're basically using momentum as your exit. So you tend to get out near the sort of rollover period rather than using a stop loss, for example, to exit the position.
The rotation will get you out of those positions with the drop in the momentum strength, won't it?
That's right. Yeah, if you think of how markets tend to top, they won't tend to go straight up and straight down. They will tend to go up. They will go through some sort of topping pattern or head and shoulders or whatever it happens to be, and then they'll start to fall after that. And as it's going through that sort of sideways topping pattern, your momentum is basically tending towards zero at that point. Yeah. So that fall in the momentum will basically act as a leading indicator to get you out in the middle of the range rather than waiting for the market to collapse. Yeah.
Alan, your regime filter, without giving away the secret sauce, are you using market externals like the index itself? What are you using for your regime filter to tell you when to exit into cash?
Yep. So there's a few different approaches that I've used in the past, and all of them are good to varying degrees. One is you can just use the index itself, so the momentum of the index ticker, for example. So if you're playing in S&P 500, you would use the SPX and just look at the momentum in that index. Look for it, when it starts to fall, you can exit your positions. A second approach might be to use the momentum on the actual stocks themselves. So if we're using something like a rate of change to measure our momentum, we might just put a floor on that value. So we're only willing to hold stocks above a certain level. That means when the bear market approaches, the stocks will fall individually at different rates, and your portfolio will naturally shrink as they fall through that floor. Yeah. And then as we recover, then the list will start to grow again. So that kind of gives you an inherent
so it's a nice staged exit into cash, as opposed to an all into cash at one moment in time with the first method.
Absolutely, that's correct. Yeah,
okay.
And then the third approach is to use an external market indicator such as the VIX. So the VIX index will tend to spike when the bear market hits. So you can use something like that, or again, looking at the VIX futures term structure in some sense to try and gauge what the future volatility is going to be.
Right.
So, Alan, you've mentioned some aspects of relative momentum and also absolute momentum. So if I've understood correctly, it sounds like you're using relative momentum or cross-sectional momentum really for the entry, for selecting the trade candidates, but you are mindful of the individual stock momentum.
Okay, so we're talking about relative momentum and absolute momentum. And the way I would characterize it is absolute momentum is that floor in the level of the index that you're willing, the level of the momentum you're willing to accept. So if we think of something like a rate of change, the rate of change being the percentage of equities moved in a particular given time period, we may say that, okay, I'm only interested in holding stocks that are up more than 20% over the last 18 months. Yeah. So that would be your absolute momentum.
Yes.
And then your entries and exits are then based on relative momentum. Okay, so out of that cohort or that short list, now give me the top 10 on that list. So then now I'm ranking them by their relative momentum. And then I'm looking at, okay, well, compared to the list I had last week, have any dropped out of that top 10? And then I'm going to sell those ones. So that would be my exit. So again, based on that relative strength in the basket versus the absolute floor.
That would be, say, a minimum rate of change for each instrument, because as no instruments are reaching that level, they're going to drop out. Because if that's not there, then there's always the top 10.
That's right. Yeah. So depending on how many stocks end up in your short list, it will either drop out the portfolio before it drops through the floor, or if there's fewer than 10 stocks or however many you pick, then it's like more likely to drop out the floor. So it's whichever is higher, the number of stocks in the portfolio or where the floor is, in that particular scenario. Yeah.
And have you had any luck with exits that could happen mid rotational period where you actually do have a stop of some sort, or it just pays to hold till the end of the week or the end of the month and just reshuffle as you would?
Yes, the latter. I haven't found any benefit to having stops in these strategies. Again, it goes back to that old thing where you're basically just going to end up locking in drawdown if your stop gets hit along the way. And, given that this is a trend following approach, we basically have to accept a level of market risk as the stock moves up and down, and you can often, with rotational approaches, you can get into a position, but you may not. You have to give it a little bit of breathing space because it may go sideways or it may go down a little bit and then take off. So you don't want to cap or get out of that position before it's had a chance to make that run.
Alan, what's your rotational holding period for? Sort of what sort of period between rotations you're looking at there?
So I rotate weekly, but the average holding period on the trades is about 3 or 4 months.
Okay. And if, for instance, during that week, we have a very negative rout on the instruments we've been trading, you're not using stops. So how are you mitigating adverse risk there during that week interim?
Well, you're not. You're just accepting that's the level of risk of trading this type of approach. I mean, I tend to think of risk as a function of the strategy as a whole rather than each individual trade, because that can be so variable. You can have a stock that drops 50% overnight, or you might have a stock that just takes off from the entry and never has any drawdown. So
once again, small bets again for this.
Yeah, absolutely.
Trend
Yes. So you're diversifying your capital, your allocation for that strategy across many different bets, whether that's, and I tend to find that the sweet spot for the number of holdings tends to be in the mid-teens somewhere, 14, 15, 16, that sort of
So you've got
number.
a similar level of diversification with your mean reversion as you do with your trend following, about similar levels?
Yeah, absolutely. Yeah. So you end up with a large number of very small individual stock risks at the end of the day. Yeah.
Right.
And Alan, so in choosing that particular cross-sectional approach to harvesting the momentum alpha out of the markets in equities, presumably you've tested some stock standard absolute momentum approaches, and you've concluded that they just don't test out as well for you in the end as the rotational approach in equities?
Yes, that's correct. Yeah. So things like 52-week breakouts and so on, they don't tend to have as much benefit as the rotational strategy has, and those particular nuances, like the crossover effect of buying one and selling one. If you're just sitting there with a bunch of capital and waiting for a load of setups, you might get a bunch one day and then they might all fall over the following week. Whereas this always being in the market, as long as your regime filter is allowing you to be, gives you that smoothing effect over time that you wouldn't otherwise get by entry, trigger, exit, stop loss kind of strategies. Yeah.
Got it. Okay. Anything else on that, Rich, before we move on to the next style of trading that Alan has?
No, I think let's get on to the volatility approach.
Okay. Talk to us about that, Alan.
Okay, so the other strategy which I like is what I would call volatility trading. I mean, it has elements of both mean reversion and trend following in it. But essentially what you're doing is you're taking a position in the market based on the future expectation of market volatility. And the way I measure that is by looking at the fixed futures term structure, which for the uninitiated is basically looking at the price of all the forward futures contracts for the VIX, the VIX being the volatility index.
It's like an interest rate yield curve going out to the long term, but you're using the VIX term structure.
That's right, yeah. And so especially the short end of that curve is very much controlled by supply and demand for the portfolio managers who hold a large quantity of stock positions and don't necessarily want to sell those positions when the market falls. They will take a hedging position by either buying options or buying the VIX futures, and that will send up the short end of that curve when the market tends to fall. So you end up with a curve which is either going up or falling, and that so-called backwardation or contango gives you an idea of what the future expectation of volatility is going to be. Volatility is very high now, the trick is to watch for when the curve flips from one to the other. For when it goes from backwardation back to contango, that's a sign that people are de-hedging rather, and they expect the market to now rise. So that what that does is it actually gives you effectively a mean reverting entry into the stock market. But then if you hold for the period while the curve remains in contango, you can actually generate a trend following trade out the back of a mean reverting entry, which is very difficult to do using anything other than that approach that I've found.
So from using the curve, you've found in your research a high correlation between the inversing of the curve or whatever and the change in regime.
Yeah, absolutely. Yeah. So the VIX futures terms curve spends about 84% of its time in contango. So, short-term volatility is, or the price for near-term volatility is low, and longer-term volatility further out is
so that's
higher.
when you're short vol in focus during that sort of 80% of the time. Yep.
That's right. Yeah. So if you can remain in a trade during that period, you're going to end up with a long holding period as the market is volatility is low and the equities market is rising, and you can take a position using an index ETF or index futures to try and realize that. And then the fact that it's in contango for such long periods of time means that when it goes, and we know this just by looking at the VIX instrument itself, that when it tends to spike, it will only spike for short periods and then it will fall again. And so by using that inversion, if you like, and then that flip, that will tend to give us that it will basically time it to either the low or the 1 bar from the low of the move in the market.
Alan, where are you getting your VIX term structure data from?
That's a good question, actually, because if you wanted to do it from scratch, you would just basically go and gather all the futures information and basically try and wrangle it and produce the data yourself. But that's very difficult to do because these are monthly futures; they're expiring all the time, and it would just be a data wrangling nightmare. But luckily, the CBOE, the Chicago's Board of Options Exchange, they actually produce continuous time series of parts, different points on the curve. So they have like a 9-day VIX, a 30-day VIX, a 90-day VIX, and so on. So you can basically measure different parts of that futures curve. Yeah, and then you can do a back test on it.
Yeah.
And so the instrument that you're trading to profit out of this would just be an equities index.
That's right. Yeah. So you could use SPY. I actually use because of the timing being so accurate in the entry, you can actually end up with quite low levels of risk in this type of approach. So I actually use levered ETFs to express a position with this. Yeah.
How did you go with Volmageddon, Alan?
Volmageddon. Which one was that? In
March 2020, wasn't it, or something? March 2020.
That one. Oh, the COVID crash. Yeah. Well, actually, very well, because this actually trades both sides. So when the volatility is shrinking, it will be long the stock indexes, And when volatility explodes, it will go long. I use an ETF or an ETN called VXX, which basically mirrors the movements in the VIX index itself. So when the equities market is collapsing, that's when this type of approach actually makes some of its best gains.
Okay.
So is this primarily a hedging strategy, or you use it because it's profitable in its own right? You like the performance of it over time in its own right?
Yeah, I like it because it's profitable in its own right, and it's a little bit uncorrelated from the other stuff I trade. But you could just use the long vol side of it as a hedging approach if you were only interested in trading equities. In fact, you could maybe dispense with your market regime filter in your rotational strategy and just use that approach as the hedge.
Alan, this isn't a diversified strategy like your other two. You're trend following a mean reversion. So how are you managing risk here in this individual strategy?
Yeah, so that is a point, and it's again, it's just looking at risk as a function of the strategy as a whole. Okay, so looking at what is the historic risk characteristics of the strategy, given that I both tested it and live traded it through many different market phases, and then I can make some expectation about what the future risk is going to be, and then I'll just manage my size based on that. Yeah.
Alan, I don't know why this just sprung into my head now, but have you traded FX or futures in the past and had a go at that, or have you just always been involved in equities?
No, I've traded everything in the past. I've traded futures, I've traded options, I've traded FX. I think I've basically landed in the equity space because that's where I find the best bang for my buck is, and also the easiest to construct strategies for, and also the simplest to execute. FX.
I know Alan's been around a long time because I saw him present at the Greek Club in Brisbane about 15 years ago, and yeah, he's an old timer in this game.
Round the block a couple of times. Yeah.
Good spot, the Greek Club. Good spot. A lot of my
but
family
yeah, I mean,
there.
I would, if new traders or beginner traders ask me for advice, my advice is always trade everything you can, trade all time frames you can, trade all instruments you can, and you will find what's going to suit your style the best.
Yeah, that's the qualitative side of quantitative trading, isn't it? I mean, there's no point trading something that you can't stomach or that's not in tune with your personality or your headspace. So,
indeed, yeah.
Okay, so how do you bring this all together then and manage your portfolio? What's your portfolio approach and your portfolio approach to managing risk?
Yeah. So what I'm looking for is a set of uncorrelated strategies which I can then allocate my capital to individually to give me the best outcome overall. And the way that the way I approach that is I use what I would call risk normalization. So I'm looking at the different risk levels in each of the strategies, and then I'm looking to allocate capital based on that risk level. So if I have a high risk strategy, I would allocate less capital to it, and if I have a low risk capital, I would allocate more capital to it. And that gives me that sort of averaging effect. And I've got a slide here I can just demonstrate that on. This is a very simplistic model, but if I just had two strategies, the purple line and the red line being two equity lines of the individual strategies, on an individual basis, those strategies may have a max drawdown of 20% each, meaning if I applied 100% of my capital to any one of these, I would end up with a 20% or worse drawdown in my outcomes. But if I took the approach of applying 50% of my capital to each of those strategies, what ends up happening is I end up with half the risk level, but still the same return outcome. Because as each individual one draws down to its maximum level, the other strategy is basically providing some juice that's going to compensate for that drawdown.
So the free lunch of diversification we see in action here.
The free lunch of I would even go further and call it the holy grail. You know. So by normalizing your strategies for the risk level and then also finding them uncorrelated, that is, they are drawing down at different times and they're making gains at different times, you end up with a much smoother ride overall. And as we know, it's not about the end outcome for a lot of this. It's really about the journey and how easy that journey is going to be.
And so with your 3 strategies that you're deploying now, sort of what level of allocation are you doing amongst those 3?
Well, interestingly, whether it's just a fluke or by luck, they've all ended up having very similar risk levels. So I'm more or less
33 and a third percent each.
Yeah, more or less.
Yep.
Yeah.
Do you ever have cash on the side, Alan? Is that part of the process at all?
Well, that can happen when the strategies go quiet for one reason or another. So for the trend following ones, that might be when the bear market's on. For mean reversion ones, and in this again, this is one benefit of trading the 2 different styles or the 3 different styles is for a trend following strategy, it will tend to draw down when the market becomes more volatile. But conversely, that's when the mean reversion strategy is just firing up. So it will tend to make gains during that time. And then as the market starts to trend again, the mean reversion strategy will go to sleep and the trend following one will start to make gains again. So you can end up with cash on the side. And I think for me anyway, it's important to recognize that that's still allocated to a particular strategy. You can't then go and reuse that on another or on the strategy. It just happens to be active at that time because you're basically just adding to your risk profile.
We'll probably get into this at the end, but you do have some strategies on ETFs too, I believe.
Yeah, well, basically all of the above strategies that we've discussed can be applied to ETFs as well as individual stock names. So you have experimented with a number of different approaches. And another one we haven't discussed is to use a diversified basket of ETFs. The beauty of ETFs being that they give you easy access. You can hold it like a stock, but it can give you access to hard to trade markets. So you could, in one construction, you could have, say, a gold ETF, an interest rate ETF, an oil ETF, a stock ETF, an emerging markets ETF, and then you can trade them as a basket. And again, using their momentum, you can basically not necessarily rotate through them, but adjust the allocations you apply to each one over time using things like their volatility and their returns and so on. So that would be that would be a different type of approach where you're always in, but you're just adjusting your allocation levels on a monthly basis.
Do you? We've spoken before about building execution software and order management systems. Do you use that, or do you require that for these strategies, or you're able to execute them manually?
They're all reasonably low frequency that they could be traded manually, but I'm fully automated. I've built my own order management system, which takes the signals are generated by the software, and the order management system picks them up and places the orders directly in the broking account.
Alan, what's your preferred system for backtesting? Have you got a preference?
So I sort of started off in the AMI broker world, and that's sort of very much been my specialty. So that's the one I continue to use, particularly on the live side. But like many people in the retail world, I've now picked up Real Test, and I've been using that.
We're moving him over.
Because it's great for doing quick research and stuff. It kind of it's very easy to use. It's got a very low barrier to entry. Personally, I think AMI Broker still gives you a lot more flexibility because it's, you can, if you can dream it up in your head, you can do it in AMI Broker. I think the simplicity of Real Test still limits it a little bit and what you can do. But for most, 95% of traders just trading, quote unquote, normal systems, you could knock them up in Real Test just as easy.
Okay. All right. So that leads into how you do test and build strategies. particularly like asking the question about avoiding overfitting as you're building strategies. So what are your techniques for avoiding overfitting?
Okay, so my testing approach, so very much, the first thing I start from is the idea has to make sense. You can't just throw everything at the wall and see what sticks. You have to start off with something that makes sense, that that you could describe in a sentence or two to someone and they would understand that. Then you're gonna build the strategy and you're gonna test it on some period of data, which is your quote unquote in sample period. So I would tend to divide up my data history into a couple of periods as a historical period. And basically what I'm looking for is that the in sample period covers many different phases or many different market regimes: bull market, bear market, sideways market, high volatility market, low volatility market, etc. And so that when I construct my strategy, I can be sure I can build in enough rules that it's going to be able to navigate through those different market regimes. And then I can also do some level of optimization within that. So I'm in a way, I'm fitting it to the in-sample data to get the best outcome that I can. But then what I'm going to do to try and avoid the system being overfit is to then test it on some period of out-of-sample data. And that will be a period of data which is usually the same markets as the in-sample period, but a much closer time period to where we are today.
So your out-of-sample is coming up to the current day. You're not, for instance, using out-of-sample first, in-sample second. You prefer the out-of-sample last?
Yeah, there's many different approaches. I tend to think that you want the out of sample period to be as close to today's markets as you can, because you're going to trade it going forward into the markets which exist today. You're not going to trade it from something that existed in the year 2000, for example. So that's the approach I tend to take. There are other approaches where you can interleaf years, odd years, even years, and so on. But the simplest approach is to use historic data to build it, and then the most recent data to test it on.
How do you handle the challenge, Alan, when you run it out of sample, it fails, it's not as good as you'd like it to be? What's the next step? And what's the mind game there?
Yeah. Okay. Well, the natural inclination is to say, oh, I know, I can just put this filter in or add this or take out that, and that will fix it, and then it'll look great.
Overfitting.
But then all you've really done is made the out of sample in sample. Then, so that's a real trap, and it's one of the hardest things in the systematic trader's life, is to have an idea you may have been working on for weeks or months, to only find that it doesn't perform in the out of sample data. But you really have to be true to yourself and throw the idea out and go back to the drawing board, because if you don't, you're almost always setting yourself up for failure once you start trading it in the live markets.
Do you use Monte Carlo testing?
I do use Monte Carlo testing, yeah. So if it passes the out of sample test, then that's the first test. And then I'm looking to basically look at, well, what's the range of outcomes that I can expect once I start trading this? And that's what Monte Carlo is great for, because a single back test or a single out of sample test is only going to give you a single number for something like max drawdown, for example. Whereas we know that, if you run that 1,000 different times going forward, you're going to end up with a number of different outcomes. So if the drawdown in the out sample test says that it's 15%, well, that could mean it could be anywhere from 10 to 25%, say, or 10 to 30%. So what I want to know is, well, what's the worst I could be dealing with? And something like Monte Carlo testing is great for that.
So, Alan, you're reshuffling trades there in your Monte Carlo. Are you doing any other form of reshuffling with your Monte Carlo, like entries, those sort of things?
Yeah, it's a lot of these decisions are a little bit discretionary, because the problem with Monte Carlo testing is that it can remove the so-called serial correlation in your results, with winners tending to follow winners, losers tending to follow losers. Serial correlation is a real thing in the market, so you want to try and preserve that as much as possible, but sometimes it's not possible. So there's a couple of approaches with Monte Carlo, you can either shuffle the individual trade outcomes themselves, or another way to do it is to actually shuffle the daily return values. So you can, so if you've got a test period of 5 or 10 years, that gives you lots of individual daily outcomes, and you can then shuffle those. And then there are techniques where you can actually shuffle series,
like the
so either
bootstrapping.
series of trades or series of daily returns, and that tries to preserve those serial correlations. But whichever approach you choose, you're always going to be making compromises somewhere. So you just have to bear that in mind when you see the results.
And Alan, how about walk forward, like Rob Pardo's walk forward technique? Are you using that at all in your process?
I must admit, I'm not a fan of walk forward because I think it has it's more really of a psychological issue with it. If you follow walk forward to its logical conclusion, what it says is that you should walk your out of sample test forward, and then the end parameter set that you get, you to then trade that forward for whatever period you've used. So if it's yearly and you walk forward, you trade that forward for a year, and then you re-optimize, and then you go forward again from there. So I think the problem becomes is when you live trade and then you re-optimize and your results start to fail. What do you do at that point? Do you then go back and use the old parameter set? Do you re-optimize again at that point? So I think it can be a recipe for tripping yourself up. So I prefer a single hit out of sample test.
Yep.
That gives me one set of parameters. I can then use them going forward, and I'll continue to use them as long as they still produce results which are in line with the historic results. And that's and I'm always monitoring that, and we can probably come on to that how to get into system health. Yeah.
Great segue then into system health. So you have a process. What is that process for monitoring those systems? Is there an expectation of eventual system decay? And then what would indicate that a system needs to be brought offline? Or do you try to build systems that endure perpetually?
So ideally, you want to build in as much smarts into your logic that it can manage the different market regimes that it goes through, whether that means profiting from them or turning itself on and off through those different periods. But regardless of what you do, your strategy is always going to have periods when it does well and periods when it does not so well. What we're trying to understand is that more particularly when it's a period of underperformance, well, is that within the bounds of expectation, or is this something unusual? So you can look at the Monte Carlo results, for example, is a good benchmark to start with. So what's my range of outcomes for things like return, drawdown, expectancy, and so on? And then you can look at the short run results. So I tend to look at things like, well, if you look at something, for example, like the wins in the last 10 trades, if you have a strategy that has a 75% win rate on paper, but lately it's only had 4 winners out of 10 or 3 winners out of 10, well, that might tell you that it's diverged quite far from what you would expect its results to be. You can also look at the drawdown, for example. If it starts to get towards 80, 90, 100, 110, 120% of what its historical drawdown has been or has tested at, then you can then say, okay, well, it's now getting to something which is unusual, and maybe there's an issue with the strategy. It's not able to navigate these particular market conditions as well as it had done previously. So all of these things can be measured, and they can be quantified and then looked at on a weekly basis or a daily basis. And you can then get what I would call a system health measure for the strategy. And you can look, is it outperforming? Is it performing under normal circumstances? Is it failing to perform? And when it starts failing to perform, or it's outside of the bounds of expectation, you can then make some decisions about what to do. And that might be continue to trade, but trade with a reduced position size. It might be suspend the trading for this particular strategy and just monitor it until it comes back into sync with the markets. or it might be take it offline completely and put it back, take it back to the bench, as it were. So just monitoring the results and making sure that how the strategy is performing on a short-term basis is in line with its long-term expectations.
That gives me an idea for a nice little piece of software where you feed in all of your historical in-sample data. It learns all the metrics, and then it picks up your daily trading numbers, and it can continue to tell you how far off you are from the in-sample statistics. You could set bounds then in which you're happy to continue along.
I'm on it, Simon. I'm on it. 10%
Get on it,
commission.
Rich. Thank you. Excellent. And then I guess the other side of being prepared to take a system offline is that when we're building systems, we're really trying to build in resilience so that they never do need to be taken offline. I guess you've already touched on that, but is there anything more you could add there on how we can best build that resilience in?
Well, I think the trick is when you're doing your initial strategy constructing and you're selecting your test period, is to make sure that you've got lots of different market regime types within that testing period, so that you've got the ability to build in the resilience right up at the start. There's no point testing a trend following system on a bull market period and then expecting it to work the same in the bear market period. You have to have put in some ability for that strategy to basically be robust enough to be able to turn itself off or to deal with those different market regime types. So that's the way I would approach it, is try and build in the robustness at the start. It's very difficult to do it on the go because you don't know if the current conditions are going to persist or if it's just a blip,
Alan, you've got your 3 systems at the moment, which you're obviously very, very comfortable with in dealing with a variety of different regimes. So is there any weak spots with those 3 strategies in combination? And is there anything you're working on to include as your 4th strategy into your portfolio?
That's a very good question. I mean, I'm always looking at new ideas as they come across the desk, and whenever I test a new idea, I'm always looking at 2 things. One, is it any better than what I've already got? And number 2, would it
plug the gaps?
To plug one of those gaps that you're talking about, and of course there are deficiencies. Sometimes the strategies will all draw down together in a line, and that can be frustrating. But whenever you try to put something else in that's going to cope with that demand, it usually ends up creating a drag somewhere else. So if you put in a hedging strategy, for example, it's going to cost you money during the time when
swings and roundabouts that occurs all the time.
Exactly. Yeah. So I guess it's about finding
the hole and the water sprouts out that one, and plug that hole and the water sprouts out that one.
That's right. Yeah. So it's about finding that best balance of how much risk you're willing to accept versus how much return you're able to achieve for that given amount of risk.
Yeah.
I was just going to ask a question before I've forgotten. Hold. Can't remember. I was just going to ask Alan, speaking about building for all those different regimes, in building in resilience and making sure we can handle regimes, whether you've done any testing on random data or bootstrap data. Rich and I are going to do a podcast very soon on using random data, and we've actually built a little tool that can produce that data. We'll make that available to everyone shortly. But have you ever experimented with artificial data?
I have, yeah. The thing about artificial data that I've found is it's actually very alluring, because if you look at it on a chart, you can see all sorts of chart patterns. You can see head and shoulders and, and double bottoms and all the rest of it. But when you test a strategy that produces good alpha on something like equities, it will basically produce flat returns on the random data, which is what you would expect because there's no actual edge in the data itself. So I don't tend to use random data in my sort of regular strategy testing, but it was interesting just from that.
Yes, well, it was a good validation that there is edge in the markets that's not in the random data. So yeah, Rich and I are going to get right into that on an upcoming show.
Fantastic! I'll look forward to that one.
I guess we should start to wrap up, Alan. So that's awesome. Really appreciate that run through. That's really comprehensive. We've covered lots of different styles of trading, things we can do with equities, why equities, advantages of equities. So what are you up to now? What else do you do? And what else is on your agenda?
Yeah, so I guess as I've been sort of going on this journey myself to become proficient in the quantitative or the systematic space, I've been invited to speak about my evidence-based approaches. So I've done a bit of speaking in the past. I've attended conferences and spoke at.
I can vouch for that.
And at various points, I usually end up getting tapped on the shoulder and asked for either advice or to do some consultancy work. So that's certainly one string to my bow, is to consult, help people get up to speed on these ideas, or given my coding background, I do bespoke coding now and again for various people as well. I also have a website where I host some of these strategies that I trade that people can look at, smartsystematictrading.com. So people can jump on there and see the sort of stuff that I trade there as well.
So that's all one word, smartsystematictrading.com.
That's it. Yeah. All one word. Yeah. Or just stick it into Google and I'm sure you'll find it. I'm very easy to track down as well, on LinkedIn and various other places. So I'm mostly trying to concentrate just on trading my account and being a good executor these days. But I've got these other sort of side projects that sort of keeps me busy when the markets aren't open.
Excellent. All right. So
you're a very good communicator, Alan, and really appreciate you coming on today.
Yeah.
My pleasure. It's been great.
Yeah, it's very helpful. So is that the best way for people to get in contact with you, to visit the website?
Yeah, so I'm on Twitter at Helix Trader, all one word, so you can find me there as well. I'm very easy to find on the internet. If you stick my name in, I'm sure I'll pop up somewhere. But yeah, if people want to drop me an email, alan@helixtrader.com is probably the best one to get me at. That's it.
Excellent.
All right. Well, we absolutely better wrap it up, but thank you so much, Alan. That's been very enjoyable. Really appreciate it.
Thanks, guys. I've had a blast. And good luck with the podcast. It's very good.
Thank you. Thanks so much, Alan. Okay.
Cheerio.
Bye, mate.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.